Well, hello, this is Jim Musgrave with Research Financial Strategies, and thank you for taking a few minutes to watch my market recap for July 2016. Again, I'm going to try to keep this to 5 or 10 minutes, and I got a lot of stuff to cover. So what's going on in the world? Well, here we are in that same range we've been in for over a year. We've been in a 15% range on the S&P 500 from May of last year to June of 2016. Again, we hit the all-time high at 2134. And we've tested this low point of around 1810, 1820. And again, we've been basically, when the market drops, we go back to basically November of 2013. So we've been in this sideways, volatile period of time, and here we are in July of 2016. Again, we go back to August of last year, where the S&P dropped 12%. We go back to January of this year, where the S&P dropped another 10% or so, and now we kind of rallied back. Last week we had the Brexit, where the people of Britain decided they want to leave the European Union. Of course, that set the stock market globally into a tailspin, but that only lasted for 2 days, and now the market kind of rallied back to where we are. So, we were in this range right here, and I also like to go back to the old school point and figure chart. So you can see I've circled these high points here. So, here we are in 2015. We hit right around in this 2130 mark. And again, last summer we dropped 12 points or so. The market rallied, but it failed to reach the highs. It kind of lost steam, rallied again, didn't hit the highs, and again, the bottom fell out early this year in January. Again, here we are in April and May, where the market rallies, but again, we still can't get through this resistance at 2130. We are so close, but we just can't seem to break out of this range. And again, on the downside, this support level is around 1820, 1810-ish. And again, you can go all the way back to late 2014 to have those same levels right here. And you go back to April 2014, and that's the range. And so it's been very, very frustrating. It's really frustrating because you could have sold your entire portfolio in May of 2015, stayed in cash, and still be better off than where you are right now. So, what do you do in this situation? Well, actually, let me tell you what's going on and why this is happening, okay? So one thing is that the earnings keep on being revised down. Okay, we're in a period of very, very slow growth. And you can see, you look at this black line. So in 2012, they estimated that the earnings would be around 12%. Of course, they revised them down to a little over 5%. And that continues year after year after year, where they start optimistic and they revise the numbers very, very low. And that's where we are in 2015. You can see they start out for a little over 10%. They revise them down to negative 2.4%. In 2016, they revised the S&P earnings down to about 2.7 as of the beginning of April. And so the earnings just tend to be revised down and very, very weak, okay? And you can see that in the first quarter of 2016 marked the 4th consecutive quarter of negative earnings growth for the S&P 500, and that's the largest contraction since the last recession, okay? So we are in a period of slow growth, so that's sort of the world that we're living in right now. Okay, a couple other things is that you can see that, again, that's not only happening in the United States, it's also happening globally. And you can see the same thing happening globally, where they have the estimated GDP. Again, that is still a pretty low, 2.4%. Again, they can revise those GDP numbers down. And the same thing with the global earnings. They start higher, and then they end up lower after they've been revised. Okay, so that's a fairly bearish sign. So I don't see any true signs of really true growth moving forward. Until we can kind of break out of this range, we're going to continue to be very stagnant, and the market's just not going to go where, not only in the United States, but globally. Okay? And when you have periods of very low growth, well, what can countries do? Well, they can manipulate their interest rates. That is the interest rate that the federal governments loan their banks, And when you lower interest rates, you can stimulate the economy because people will tend to borrow more to buy more goods and services when the interest rates are low. The problem is that you get into a deflationary period, and you can't fight deflation with deflation. And you can see, look at Switzerland. They have a one-year yield, the yield on their one-year treasury bond, the equivalent, is negative 1.1%. Okay, that is not a good sign. That is a bearish sign. That's not good. And you look at a dozen countries right here that are in periods or a period of negative interest rate on their government bonds. Okay, so the U.S. yields are roughly 0.53%, but that's just on a one-year Treasury note, but that is still pretty pathetic. So that's the overall snapshot of how things are going on in both the stock and bond markets globally. You can't make much money in the fixed income arena, and you can't make much money in the international equity arena as well. So, so where can you make money? What else is going on? Well, let's kind of go back to one of my favorite charts, and I've shown this to you guys before, is actually Dolly. So Dolly is the dynamic asset leveling investing, and what it does is that it ranks all the asset classes that you and I can invest in from the best to the worst. And what's interesting is that commodities, as of just last week, they used to be in the worst place, in the worst asset class. Now they've jumped from the worst to the best as one of the best places to be in right now. So right now, commodities, fixed income, followed by U.S. domestic equities, followed by cash. These are the top 4 asset classes to be in at this point. And when you kind of drill down, where sectors are really doing well. Well, you have energy. That's going to be oil primarily. So energy's been doing fairly well, and also gold. So when you have a period of volatility and uncertainty, people tend to buy gold and silver. And we can see those two sectors have done very well. I'm going to hit that in just a second. So we've seen that commodities have done very, very well. Okay, second thing, we've also had fixed income. We've had long duration treasuries, and also another asset class that's doing well in fixed income are preferred stocks and convertibles, because people are willing to take a little bit more market risk to get a higher dividend on their investments. And so we actually have a preferred stock ETF in our advisory portfolio that's doing very, very well. Again, we also look at domestic equities. We have pretty much it's a growth story right now. We have large growth, mid growth, and these are the areas that are outperforming the value stocks at the moment. When you actually kind of drill down into the sectors, utilities have done very well because utilities tend to be a defensive play. So you go with these companies that have pretty consistent dividends, and people like the dividends, and so the utilities tend to do well as consumer non-cyclicals, basic materials, and technology down the road. Now, again, with the yields dropping and all the uncertainty, financials have really taken a hit in recent times, and so financials are the worst performing asset class right now in terms of U.S. domestic equities. And when we actually kind of drill down to the performance, surprise, surprise, gold miners and gold stocks, or the gold in general, is doing very well. If you look over here in the year-to-date column, you can see that gold miners are up over 111%. Gold is up over 26%, followed by utilities. Again, the defensive play. People like the defensive stocks and they like the dividends. But look at this. TLT, the 20-year Treasury bond, is up over 16% year-to-date. Again, the asset classes that are doing well are defensive sectors. Okay, we talked about commodities being good. We also have commodities right here. The commodity index is up over 16% year-to-date, followed by energy. Again, XLE, the energy sector. Again, that's a commodity. It's an energy play that's up nearly 14%. And so, again, you can look at these sectors that you can see which ones are doing well. It's the defensive, it's the defensive sectors. So again, kind of moving forward, now is certainly a time to kind of be in a neutral to defensive posture. Um, Taking a more conservative approach is probably going to be the best play. There will be continued volatility. There will be continued uncertainty. And in this kind of an environment, um, you know that I'm a tactical investor, but there is certainly an argument to be made by taking your large cap dividend yielding sectors and just kind of hold them and just kind of wait out the volatility, because the problem that many investment advisors are having is that things have become so volatile that we set a stop loss, and then that stop loss triggers, and that what you just sold now rebounds very, very quickly, and you get whipsawed. And so that is one of the challenges that money managers are having right now. And so kind of taking a slightly longer term approach, I think, can kind of keep you in the market longer and reduce the chances of you being kind of whipsawed and kind of jerked around when we have these crazy volatile markets like we've had in the S&P. I mean, you see these huge candlesticks right here. So it's just the world that we're living in. So again, the market has kind of rallied, but you can see it's kind of lost some steam. What will happen moving forward? Well, summer tends to be a period of time where there's increased volatility and things aren't as good. But come October and in the winter months, that tends to be historically a better time for the overall stock markets to perform. So, we've got, again, globally, a period of very, very low GDP. We've got a lot of uncertainty with the Brexit. We have about every country out there trying to manipulate their currency, and that's causing havoc. We also have the election coming up, which, it's not going to have a huge influence on the markets, but it does cause some uncertainty for a lot of people. And that's just kind of where we are right now. So that's kind of where I'm going to leave the video this week. So again, if you guys have any questions, you want me to review your portfolio, if you're not a client and you just want to get a second opinion on how you're doing, how your 401k is allocated, or if you want to do any kind of projections in terms of retirement and just all those sorts of things, certainly contact me. All you have to do is give me a call. Again, my number is 301-588-0514, or you could visit my website, jimmusgrave.com. And so until next time, I hope you found this helpful and good investing, and have a great summer. Take care now.